Hey guys, Michelle Massio here. Thanks for checking in. Thanks for checking out my video. I want to do a quick video. I've had a couple questions recently on the timing of options expiring. When do they expire? When can they be assigned? So this is just going to be a quick video just on talking about those things. So basically, what you want to do is you want to look at the expiration date of the option. So basically, the expiration date is when that option expires, and it expires at the close of the market on that particular date. So typically that's going to be 4 p.m. Eastern time on that particular date. Now that's when they expire. That's when there's no more risk on that particular contract. However, when can options be assigned? That's a little bit different. So options can be assigned anytime they become in the money. Let me give you an example. Let's say you are selling a put of ABC stock, whatever that is. And let's say it's $100 put. Let's say the strike price is $100. So anytime the price of ABC goes to 100 or lower, that option can be assigned. What that means is the buyer, the purchaser of that option, can put that stock to you, requiring you to purchase 100 shares at that particular strike price, right? Now, oftentimes what happens with stocks, they go like this, right? So there's a lot of volatility always with stocks, right? That's inherent in the stock market. And oftentimes what we see is we see a stock, let's say ABC stock, dip below 100 and then pop back up over 100. So what does that mean? That means that anytime it dips below 100, it can be assigned. If and when that were to happen, you would just basically see the shares, you'd likely get some sort of notification from whatever custodian you're using, and then you would see the shares show up in your account, and you would see the cash debited from your account to pay for those shares. Now, I would say probably an estimate of 90% of the time, perhaps even higher, options will only be assigned on the expiration date at the close, right? What do I mean by that? What I mean by that is that oftentimes, and this is a great advantage to an option seller, but oftentimes the stock will drop below that price, and the purchaser of that option, of that put in our example, will not assign the stock, right? So they will wait until the expiration. And the reason for that is that most people that buy options, they're not necessarily hedging their risk. They can be. So some purchasers of options are hedging their risk, but many purchasers, that's a tongue twister, purchasers of options are trying to 10x their money, meaning that they want to buy an option for, let's say, $100, and they want to turn that 100 into 1,000. So they're really not looking to buy or sell any of the shares, but they want to liquidate the contract at some sort of a profit. So that's an advantage to us being the option sellers, right? So in closing, what you want to remember is that options expire at the close of business, at the stock market close, which typically is going to be 4 p.m. Eastern time on that particular expiration date. However, options can be assigned early. They can be assigned anywhere between the time that the option is sold and the expiration date. It's up to the purchaser of the option. Typically, as the seller, you will just see that in your account, but usually 90% of the time, it will only be assigned at the expiration date. So that's an advantage to the seller. Anyway, I hope this information helps. If you have any questions, please feel free to hit me up. You can write a comment here or a question here, or you can message me as well if you have my contact information. Please subscribe to the YouTube channel and let me know if there's other videos that you're interested in seeing. Thanks. Happy Friday, and cheers. Have a great weekend, everybody.